Welcome back to Calm Investors. I am Ruth.
And I am Patrick and Ruth. This is it. Episode 10, the Season 0 finale.
The graduation episode.
The graduation episode. And I want to take a moment before we dive in, because I have been thinking about where I was when we started this series. Episode 1. You asked me to calculate my net worth, and I remember sitting there thinking, I do not even know what that means. I did not know the difference between rich and wealthy. I had never tracked my spending. I had credit card debt I was ignoring. No emergency fund, no insurance review, no savings automation, no goals, nothing.
And now?
And now? I know my net worth, I track my spending. I have a debt payoff plan and I am making progress. I have an emergency fund growing every month on autopilot. I reviewed my insurance. I am paying myself first with automatic transfers. I am thinking about growing my income. Not just cutting expenses. I have 3 written financial goals with timelines and numbers, and I know the difference between saving and investing. I did not even know my net worth. Now I have a complete financial foundation. That is 9 episodes of real change.
And I want every single listener to hear this, if you have been following along and doing the homework. You have done something remarkable. You have built a financial foundation that most people never build. Not because they cannot, but because nobody showed them how. Nobody walked them through it step by step. You did the work, and you should be proud of that.
I am proud genuinely. So what are we doing today?
3 things first. We are going to run through the complete Ready to Invest checklist. 9 items, 1 for each episode. This is your final exam, except there is no pass or fail. It is just a mirror to show you where you are. Second, we are going to talk about where to put your first investment dollar, because the account you choose matters more than most people realize. And third, I am going to give you a preview of Season 1, because the journey is not over. It is just beginning.
Let us start with the checklist.
The Ready to Invest checklist. 9 items. Here we go.
Item 1. From Episode 1. You understand the difference between rich and wealthy. Rich is income. Wealthy is restraint. Wealth is the money you do not spend. You have shifted your mindset from showing off money to building real wealth.
Item 2. From Episode 2. You know where your money goes. You have done a spending audit. You can name your 3 biggest expense categories. You are no longer guessing. You have data.
Item 3. From Episode 3. You have a plan to eliminate bad debt, or it is already gone. You know the difference between good debt and bad debt. You have picked Snowball or Avalanche, and you have auto-pay set up on all your minimums.
Item 4. From Episode 4, you have an emergency fund started. Ideally 3 to 6 months of essential expenses. Even if you are not there yet, the account exists and money is flowing into it automatically. You have a financial seatbelt.
Item 5. From Episode 5. You have basic insurance coverage, health insurance, renters or homeowners insurance. If you have dependents, life insurance. You have reviewed your coverage and you are not one disaster away from losing everything.
Item 6. From Episode 6. You are paying yourself first. You have an automatic transfer set up on payday. Money moves to savings before you can spend it. Systems beat willpower. The system is running.
Item 7. From Episode 7. You are thinking about income growth, not just expense cutting. You know your market value. You are investing in your skills. You understand that your career is your biggest financial asset.
Item 8 from Episode 8. You have clear financial goals with timelines, short-term, medium-term, long-term, written down, with numbers. You know what you are building toward.
And Item 9. From Episode 9. You know the difference between saving and investing. Saving preserves, investing grows. You have labeled each of your goals, save for this or invest for this. You understand inflation and why long-term money needs to be invested.
That is the checklist. 9 items, 9 episodes. If you can check off most of these, not all, most, because progress beats perfection, you are ready to invest your first dollar.
And if someone is listening and they cannot check off all 9,
then go back. That is the beauty of this format. The episodes are not going anywhere. If you skipped the emergency fund, go back to episode 4. If you have not written your goals, go back to episode 8. There is no deadline, there is no rush. The market will be there when you are ready. It is better to take an extra month building the foundation than to start investing on a shaky base.
I love that. The market will be there when you are ready.
All right. Now for the question every beginner asks once they are ready: where do I actually put my first investment dollar? Because it turns out, the account you use matters a lot.
What do you mean the account matters? I thought you just open a brokerage account and start buying.
That is what most people think, and it is a mistake that can cost you tens of thousands of dollars over your lifetime, because there are accounts that give you tax advantages, meaning the government gives you a break on taxes to encourage you to save for retirement. And if you skip those accounts and go straight to a regular taxable brokerage account, you are leaving free money and free tax benefits on the table.
Free money? Tell me more.
There is a hierarchy, an order of operations for where to put your investment dollars. And the first step is the most important. If your employer offers a 401k with a match, contribute at least enough to get the full match. Let me explain what that means. A 401k is a retirement account offered through your employer. You contribute a portion of your paycheck before taxes, and many employers will match your contribution up to a certain percentage. For example, your employer might match 50 cents for every dollar you contribute, up to 6% of your salary.
So if I put in 6%, my employer adds another 3%. For free?
For free. That is an instant 50% return on your money before it is even invested. No stock, no fund. No strategy in the world gives you a guaranteed 50% return. Your employer's match is free money, and not contributing enough to get the full match is literally turning down free money. If you earn $50,000 and your employer matches 3%, that is $1,500 per year you are leaving on the table if you do not contribute.
$1,500 a year, just sitting there waiting for me to claim it.
Exactly. So step 1, if you have a 401k match, get the full match. That is your first investment now. Step 2. Once you are getting the full match, the next place to look is a Roth IRA. A Roth IRA is an individual retirement account, meaning you open it yourself, not through your employer. The special thing about a Roth IRA is that you contribute money you have already paid taxes on, but then it grows tax-free. And when you withdraw it in retirement, you pay 0 taxes on the growth, tax-free growth, for decades.
Roth IRA, tax-free growth. So I pay taxes now, but everything it earns over the next 30 or 40 years is mine. No taxes.
That is the deal, and for young investors, it is an incredible deal because you are probably in a lower tax bracket now than you will be later in your career. So you pay a small tax now and avoid a bigger tax later. The current annual contribution limit for a Roth IRA is around $7,000. Depending on the year. That is the maximum you can put in per year.
Okay, so step 1, 401k match. Step 2, Roth IRA. What is step 3?
Step 3 is to go back to your 401k and increase your contributions beyond the match, working toward the annual maximum. The 401k has a much higher contribution limit than the Roth IRA. Over $20,000 per year for most people. The money goes in before taxes, which lowers your taxable income now. It grows tax-deferred, meaning you do not pay taxes on the gains until you withdraw in retirement.
And step 4?
Step 4 is a regular taxable brokerage account. This is the account with no special tax benefits. You pay taxes on dividends and capital gains as you go, but It has no contribution limits and no restrictions on when you can withdraw. It is the most flexible account. You use it after you have maxed out the tax-advantaged options. So the full hierarchy is 401k match, then Roth IRA, then max out your 401k, then taxable brokerage.
401k match first, Roth IRA second, max 401k third, taxable fourth. That is the order.
That is the order, and I want to be clear. We are explaining concepts here, not giving personalized tax advice. Everyone's situation is different, but this hierarchy is the general framework that most financial educators agree on. It ensures you capture free money first, then tax-free growth, then tax-deferred growth, and finally, taxable investing.
Got it. Concepts, not advice. But the framework makes sense. Start with the free money and work your way out.
Now let us talk about what comes next, because Season 0 is ending, but your investing journey is just beginning.
Season 1. I have been waiting for this.
Season 1 is called The Psychology of Wealth, and it is about the most important topic in all of investing. Not stocks, not bonds, not index funds. Your brain. Because here is the truth that the data makes painfully clear. The average stock market return over the last several decades is about 10% per year. But the average investor earns only about 3.5%. That gap between what the market returns and what investors actually earn is entirely caused by behavior. By emotions, by your brain making decisions that feel right, but are mathematically wrong.
10% for the market, 3.5% for the average investor. That is a massive gap.
It is, and it means your biggest enemy as an investor is your own brain, not the market, not the economy, not politicians. Your brain, it is wired to buy when prices are high because everyone else is buying and it feels safe, and it is wired to sell when prices are low because everyone else is selling and it feels dangerous. Buy high, sell low. The exact opposite of what you should do, and almost everyone does it.
So Season 1 is about learning to override that wiring.
Exactly. In Season 1, you will meet Mr. Market, Benjamin Graham's brilliant allegory about treating the stock market as an emotional business partner, not an advisor. You will learn about loss aversion, why losing $100 hurts twice as much as gaining $100 feels good, and how that asymmetry destroys portfolios. You will learn about FOMO and herd mentality, why bubbles form, and why you will be tempted to chase them. And you will build what I call emotional armor, the mental frameworks and pre-made decisions that protect you from your own worst instincts.
Emotional armor, I like that, because the foundation we built in Season 0 protects my money, but the emotional armor in Season 1 protects my decisions.
That is beautifully put. Season 0 is the financial foundation. Season 1 is the psychological foundation. You need both to be a successful long-term investor.
I cannot wait, but first, let us close out Season 0 the right way. Takeaways.
Number 1. The Ready to Invest checklist has 9 items, 1 from each episode: mindset, spending awareness, debt plan, emergency fund, insurance, automated savings, income growth, written goals, and understanding saving versus investing. If you can check off most of these, you are ready.
Number 2. Where you invest matters as much as what you invest in. Follow the account hierarchy. 401k match first, that is, free money. Roth IRA second, that is, tax-free growth. Max out your 401k third, taxable brokerage fourth.
Number 3. If your employer offers a 401k match and you are not contributing enough to get the full match, fix that immediately. It is the highest guaranteed return you will ever find, often $1,000 to $3,000 or more per year in free money.
Number 4. Your homework. Run through the 9-item checklist. For any item you have not completed, go back to that episode and do the action item then. If your employer offers a 401k match, sign up and contribute at least enough to get the full match. That is your first investment. If your employer does not offer a match, look into opening a Roth IRA. Your future self will thank you.
And number 5. Season 1 starts soon. The psychology of wealth. Your biggest enemy as an investor is your own brain, and we are going to teach you how to beat it.
Ruth. Before we sign off, I want to say something to everyone who has been on this journey with us.
Go ahead.
10 episodes ago, I was the person who knew I should be doing something with my money, but had no idea where to start. I was overwhelmed. I was embarrassed. I thought investing was for people who already had money, and now I am sitting here with a financial foundation I built myself. Step by step, episode by episode, and if I can do it, you can do it, because none of this required a finance degree. None of it required a high salary. It just required showing up and doing the work.
And that is the message I want to leave you with. You do not need to be rich to start building wealth. You do not need to be an expert. You do not need to have it all figured out. You just need a foundation, and now you have one.
If Season 0 helped you build your foundation, follow Calm Investors wherever you are listening. Share this series with someone who is where you were 10 episodes ago. Everyone deserves a starting point.
You built the foundation. Now build the wealth. We will see you in Season 1.
See you in Season 1.
Stay calm, build wealth,